Welcome, everyone. My name is Michael Naidrich. I am the COO of Amerivet Securities. I am joined today by our head of rates, Gregory Faranello. How are you, Greg?
I'm good, Mike. How are you?
First of all, I'd like to give you a virtual hello, and I just want to wish all of our clients and friends health and safety in these uncertain times. And I just feel grateful that we're able to continue running our business, and really grateful that you made some time for us this afternoon.
It's great to be here. Thank you for having me.
No, thank you. So I would say what has gone on since the last meeting, but I'll say what hasn't gone on since the last meeting. I know there was a couple of target dates, and then they superseded the date, and then they put the rates down to zero in the middle of all that. So why don't you kind of catch us up and let us clients know where we're at a little bit?
Yeah, sure. So this is the last formal time that the Fed has met in really quite some time. March 3rd was the last time that they March 18th was supposed to be their last meeting day. They came in on March 15th. They lowered rates down to zero. They superseded the March 18th meeting. With that meeting, said they canceled their regularly scheduled meeting. So this is really the first meeting that we've had in quite some time, formal meeting.
I would think that a lot of people are looking to see some of the biases in this meeting. There's been so many initiatives by the Fed. I guess rightfully so, as we face this pandemic as a country. Can you give us an idea of some of these initiatives and your viewpoint on them?
Yeah, sure. I mean, so, the Fed initially came in and lowered 50 basis points intermeeting. Then they came in and took rates down to zero. And since there, they've really embarked on a number of different programs as the market structure has changed. Some of those programs relate back to the 2008 financial crisis, and some of the programs are new. You look at sort of the commercial paper vehicle, you look at the money market vehicle, the primary dealer facility, and then you look at some of the newer facilities that they put in place, namely the primary and secondary credit facility, the municipal facility that they've recently expanded, obviously the Main Street lending facility. So it's really been a confluence of events in terms of what the Fed has put in place. They refer to it as the alphabet soup because there are a lot of initials and acronyms, but at the end of the day, some of these programs are old and some of these programs are actually new.
Yeah, I mean, the Fed's been everywhere. Can you give me a viewpoint on how the Fed has impacted the market?
Yeah, I mean, I think the real changing point in the marketplace was March 23rd. The Fed came in, they basically said unlimited balance sheet. In conjunction with that, they announced the programs with regard to the secondary and primary corporate trading market. If you look at what risk assets have done since March 23rd, obviously risk assets have performed extremely well, equities in particular. If you look at the corporate bond market, we've had record issuance coming into the marketplace off the back of the Fed underpinning some of these facilities, which, quite honestly, in terms of high quality issuers in the marketplace, unlike 2008, what we're seeing now is the marketplace is open for issuers that were issuing before this. And we've also seen issuers come into the marketplace that haven't issued in quite some time.
Yeah, I mean, it's really amazing to watch. As we're seeing, to your point, companies haven't issued 5, 6, 7 years hitting the marketplace, and some of them hitting it multiple times over the last 6 to 8 weeks. I saw one of the big banks today actually did a European deal also. Is there any way we can judge where the Fed's balance sheet is right now?
Sure. So if you look at the Fed's balance sheet, call it the beginning of March, we were roughly 4.2 trillion. We're about 6.5 trillion right now. And if you sort of decompose that on the asset side, obviously they bought a lot of treasuries. Ironically, on March 23rd, when they said the balance sheet was unlimited, where we were in terms of Treasury purchases then versus where we are now, they've tapered back quite a bit. Mortgage-backed securities, some of the new facilities, if you look at the balance sheet, they've opened that up on the primary side, the primary dealer credit facility. So on the liability side, if you take a look at those numbers, bank reserves are way up, and also the Treasury's general account, which is really the account that that's held at the Fed by the Treasury to fund really some of the money that's going to be needed in the CARES Act. So the balance sheet in it by itself on an absolute basis is up quite a bit since the beginning of March.
Does the Fed have any bullets left? You know, what's their next move if we do not assimilate back in you know a meaningful time, or even if we do, small businesses are not so quick to you know return back to normal business?
I think the Fed has done a lot here. I don't think it's really a matter of what they've done. I think it's a matter of tweaking, perhaps, some of the programs that they put in place. But on March 23rd, the Fed basically said in their mind, they don't have a finite matter of bullets. And I think they're willing to expand the balance sheet. We're at $6 trillion right now. I don't think it's inconceivable that we see that balance sheet grow to anywhere from 8 to 10 trillion.
Amazing. I guess if you hang around the street long enough, like guys like me and you have, although you know, you can see anything, right? Expect the unexpected. All right, you know, I guess my last question for you is, you know, what should we expect from the Fed at this meeting? What are you looking for? We do this every time. I always ask
Sure.
you, you know, are they going to raise? Are they going to hold? Are they not? I don't know if that's as appropriate in this time with everything that's going on. But, you know, we at AmeriVet, we're independent. We like to put our opinions out there. So, you know,
Sure.
please let us know what you're thinking.
Reality is, I think the Fed has done a lot here. I think for Chairman Powell, tomorrow it will be more about explaining what the Fed has done. He's going to do a video conference. He will be questioned, I think, pretty explicitly in terms of the details of what they've done. Now, mind you, we have context going back 12 years in terms of the 2008 financial crisis. Not all of these programs are the same. The legalities around Dodd-Frank in terms of the Federal Reserve Act and what the Fed can and can't do in conjunction with the Secretary of Treasury, Secretary Mnuchin. He's doing, I think, a fantastic job. And I think the chairman's doing a fantastic job too. But I think they need to explain a little bit more explicitly to the American people what they're doing and why they're doing it. More specifically, Mike, to your question in terms of tomorrow, you know, the Fed funds rate has been trading through their administered rates, namely the interest on excess reserve, which is one of the administered rates that they use to keep the funds rate within their target band. That rate has been trading through the interest rate on excess reserve. So relative to a 0 to 25 basis point band right now, the interest rate on excess reserve at 10, the Fed funds rate has been trading through the interest rate on excess reserve. We had T-bills recently trading negatively. So I think Chairman Powell needs to clarify negative interest rate policy from the Fed versus cash markets trading negatively. So I'd like to see them raise the interest rate on excess reserve by 5 basis points. The reverse repo rate, which is set at the lower bound at 0, up by 5 basis points. I think that's plausible that they do that, and I think that would be totally appropriate. In conjunction with that, I'm looking for the chairman really to talk about the policies that he's put in place and really talk explicitly toward the Main Street lending facility, which is really uncharted territory for the Fed in terms of lending to middle market corporates.
All right, I can do this all day with you. I have one last question for you. Is it possible the Fed buy stocks, ETFs? I know there's some legislation around that. I know some people might have a belief they already are. What's your thoughts on that?
I think the Fed should stay away from equities. I really do. I mean, that's my thought. I mean, they put ETF baskets in their repertoire. But look, I mean, the underlying assets in ETFs, I think that market needs to sort itself out. We're seeing some of this. You and I have talked about this extensively in the oil market. Yep. And I think this is one of those very dynamic situations where the reality of the ETF market and the underlying assets, that needs to work itself out over time. We've seen some major dislocations here in the last month and a half. I think the Fed should stay away from the equity market. I think, honestly, what they've done in terms of the credit market, if you look at what they've done in the primary and secondary credit market in terms of the underpinnings of that market since that announcement on March 23rd, that's when the equity market bottomed out. So, you know, I'd like to see them take a little bit of a step back here, a little bit of a step back. Take a look at what they've done, analyze some of the decisions that they've made, some of which have been good, and I think some of which they may question over time and plow forward. But I wouldn't dive forward here with equities directly.
I agree with you on that one, but you never know, I guess. Greg, I just want to thank you. I know how much work you put into this on behalf of our clients and our firm. If any of our clients would like to have a meeting with Greg to dive deeper into this, I promise you, Greg is all things rates, liquidity, and stimulus. And again, you know, we just want to wish all of our clients and their families well. And let's get through this together. Thank you, everyone. Have a nice night.